Getting into trades is important, but when you get in, you need to make sure that you have your stop loss utilized in the best possible way to make sure you can also get out profitably. Now, this may be reducing the losses you take or trading your stop loss into profit to turn trades into a win-win scenario. Whatever it may be in terms of stop loss utilization, we are going to cover it in today's video. So let's get to the learning. A stop loss is an order that we place on a trade to safeguard us from taking big losses. So every time we get into a position, we obviously hope that the trade is going to move in our favor, but sometimes it's not going to. In fact, about half of the time you get into a trade, it's going to lose. Now, if we know that half the trades we take are going to lose, we want to make sure we can get out for minimized losses. So we place a stop loss on every trade. We put it at a predetermined level with a predetermined number of risk. In this instance, it would be $1,000. And then if the market is to go against our position, it stops us from taking a $3,000, $4,000, $5,000, or even $6,000 loss. We just get out with the $1,000 predetermined loss and we can get in later. So there are three things we can do with stop losses. Number one, avoid large losses. Number two, avoid losses altogether. And number three, maximize profits on trades by turning trades into a win-win scenario. The first is your general stop loss, like this down here. This is obviously what we've just discussed. It's a safeguard for your position. If the trade moves bad, you're going to get out with a predetermined loss that is controlled, and it's not going to get out of hand and destroy your whole account. Now, if you get into a big drawdown by not using stop losses, it's very hard to recover, so it's worth just taking the minimized loss. Now, the second way that we can use stop losses, because stop losses are flexible, they are just an order that we send to the market, meaning we can change the price of the stop loss at any time. So the second way we're going to use them is to go break even. Now, a break even is where we limit our loss completely by moving our stop loss to the price that we entered the trade at. So when the trade is moving in your favor, let's say if the market was moving up to this level, we could now move our stop loss to the break even level or the price that we entered the trade at. And then if the market is to flip on us and go back down to the stop, we're getting out for free. We are not having to take a loss on this position and we're not letting this win turn into a loss, okay? Now, we have commissions to account for on many accounts. So you could move your stop loss 1 or 2 pips above your entry price, and this will actually pay for the commissions as well by paying you a small amount of profit if the market reverses to break even. The third way to benefit from stop losses is by stop loss trailing. So every time the market moves up and forms a new little high and low in the market, we can actually grab our stop loss and change those numbers to fit under previous structure. This way, if the market decides to flip on us, we're going to get out for a profit. In this instance, if our stop loss was here under this small indecision candle, we'd be getting out for around 1% in profit, even though the stop loss is hit. When the market makes new highs and lows, we can just follow those lows with our stop. Then we'd be pulling in about 3% profit. And obviously in this trade scenario, the trade worked out perfectly. But that's not always going to be the case. Sometimes trades will work in your favor, and then just before they reach the target, they'll flip on you. And if you don't utilize the methods that I'm going to teach you today, you can turn a lot of big wins into some serious losses. There are 2 core mistakes that traders make when it comes to positioning stop losses. Number 1 is putting your stop loss too far away from your entry price, which means your risk reward is too small and your trades are not going to return much profit at all. And number 2 is putting your stop loss too close, aiming for really high risk reward ratios. Now, if you put your stop too close and it's unreasonably close, you are likely to get stopped out of a lot of trades, even though you're right on the position. Even just little wicks and tiny movements against your trade can stop you out, turning potential big winners into immediate losers. There are 2 core mistakes that traders make when positioning their stops. Number 1 is having your stop loss too close. Number 2 is having your stop loss too far away. So in this instance, if we were taking a trade from this demand zone, we have a nice buy. Awesome. But if your stop loss is going to be really far away, say if you're using a fixed stop loss of 50 pips, or if you are putting your stop loss under considerably further away lows, you are limiting the amount of profit you can make on a trade. Now we can see this is a very nice large movement. It's around 155 pips. We don't really want to only pull 2.8 or 2.5% out of a trade like this, because we can make considerably more. So what we want to do is try and find the balance. Now, what other traders will do is have stop losses way too close. They might buy from the top of a zone and have the stop loss still somewhere inside of the zone. Or they might go down to look at like a 5-minute zone inside of the larger area and put their stop underneath that, which is then prone to being wigged out if the market decides to pull deeper into an entry zone or point of interest. So we want to strike the perfect balance, and it's very simple to do this. All we want to do is consider where the swing low or swing high is when we're getting into a trade. So if we have this demand zone here that we're looking to buy from, our stop loss is going to be just underneath the swing low. So we would have our stop loss just there. Now, the reason that this is going to work so well is because we are generally in our trades trying to follow the market structure. This is a market with bullish structure. We're making highs and lows continually, which tells us that the market is trending up. Now, for a market to change direction, it has to change from the higher high, higher low format into a format of lower lows and lower highs. So if this swing low broke, that would generally change the direction of the trend completely. If the trend direction changes, we no longer want to be in this trade because we are looking to buy, right? So we could cross this trade off and move on to the next, potentially even changing the direction of the position. So this is why we don't need to have stop losses really far away. We want to try and work out the level where the trade is invalidated. Our goal is to only be stopped out when our trade is wrong, but also make sure that we're stopped out when our trade is wrong. If we have our stop loss somewhere refined using lower time frame price action and it's still sitting in the zone, well, it's very easy to be stopped out of this position, but still be right. If the market came down to the very low of the zone and you got stopped out because your stop loss was somewhere inside of this higher time frame zone, then your trade was correct, but you still lost money. That is a terrible position to be in. It hurts your feelings and it hurts your trading balance as well. But with a really big stop, there's no point having a stop this big, because we generally know now if this low, this swing low here breaks, the trade is invalid. So there's no reason for us to hold on hope in a market that is now shifting into a downtrend. So we would generally just prefer to get out of the trade as soon as the trade's invalidated. When that swing low is taken, we hop out, we take our minimized loss, but our stop loss is small enough to make sure that we're maximizing the profit potential of each position. So rather than having to trade with a 2 or 2.5% reward to risk profile, we can trade with a 4.36 reward to risk profile, meaning for every $1,000 risked here, we're aiming to make $4,360 in profit. Now, it's attractive to have small stops because the profit potential you make on trades can be very big. Take a look at this for example. 13.88 is the reward to risk profile on this position, which means if you risk $1,000 here, this profitable movement will pay you back $13,880. This is one of the biggest problems that I see beginners making. Over-refining and trying to get super tight stops. If you aim for these super tight stop losses like this position, yes, you can bring brilliant profits when a trade wins, but your win rates are going to be so low that it's going to stress you out too much. You'll probably break the system. And if you don't break the system and you do follow the rules through the 7 out of 10 losing trades, well, you're not going to actually be too much better off than a trader who just trades a bit more conservatively, wins more positions, but makes a smaller return on the wins. It's a lot easier to win positions like this one than it is to win positions with very tight stops. And yes, you are making less per trade, but you are winning a lot more trades when you trade in this way. When you over-refine, you're going to get stopped out back to back to back. And when one trade finally wins, you're probably going to be too scared to hold it out anyway. So ultimately, when we are choosing stop loss positioning, we want to choose the place that will invalidate the position. That is where our stop loss should go. If we are wrong, we want to get out as soon as possible, but if we're not wrong, we certainly don't want to get out. So the first trade entering from demand in an uptrend, our stop loss would go beneath the higher low, which would be this level here. If our stop loss is under that higher low, then if the market continues trending up, we have no risk. If the market turns on us, then we just get out as fast as physically possible without turning the loss into something bigger than it needs to be. Now, as I said, sometimes it can be appealing to get the smallest stop loss possible. So if you were entering a trade here, you might want to go with a stop loss like this. But if we still have open price ranges and there are still areas below that the market could trade into, such as a smaller demand down here, then sometimes it's better to just go with the wider stop. Now, if you're in an uptrend, you've got a lot of potential to take this trade higher. But taking your position like this, once again, utilizing that invalidation point for your stop loss positioning, so putting it under the previous higher low, is going to make sure that even if the market trades down into some of the extreme lower areas of this trending move, you're going to still be in the trade. If you've got that super refined stop, yes, your risk reward is looking good. But if the trade flips on you like this and the low that you're relying on gets liquidated, then you can be stopped out even when you're still right on the trade. And a lot of the times, using more conservative stop losses is still going to provide you with a good risk reward of 4, 5, or 6%. So there's no reason to try and push it to 10 and kill your win rates in the process. That is the safest way to position your stops. Okay, now let's talk about going break even. So this is where you move your stop loss to your entry price or just below or just above, depending if you're selling or buying, to make sure you limit all of the risk on your position. Turn your trade into a win-win scenario where you either win or get out scot-free. Should you go break even at this point that we're trading at right now, where we have just made a small push away from the entry? Well, on the majority of positions, I would say no, because at the moment, we haven't actually made a new structural low. None of this range here has been broken. We still have some structural lows intact, which basically means this market can still range. This push down doesn't actually mean a lot until it breaks previous lows. It's possible for the market to do this, mess around a bit before finally making its movement down. So if you go break even this fast, you will, promise you, save yourself from a few losses. But you will also, and I promise you this too, miss out on a massive amount of profit by getting stopped out at break even before your trade moves into your favor. I'm sure you might have encountered this yourself if you've already attempted the break even strategy. So how should we be going break even then? Well, the simple format is to wait for the market to form new lows. So if we take a look at this market where we've actually pushed down and formed a new low, pretty much from this point onwards, here, we could go break even, okay? We've seen the market form a new low. Now, it is only a wick, but we are just trailing here. We're not using this for entry confirmations. Because we've seen the market form this new low, we can go break even safely. Because if we reconsider the structure of the market now, we have this high, we have the low, we have the lower high, and we have the lower low. So at this point, if the market pushes above pretty much this supply zone that I'm plotting out here, we wouldn't really want to be in this trade, right? If the market somehow built the strength to push back above this high, it's likely that it's going to push the other way with some strong momentum because we're obviously seeing considerable strength in that market. So you can start to go break even when new lows have been broken, which in this case is going to be around this point here. That is where you would break even your trade and make sure you don't lose. And it's recommended to not do it any earlier than that, because if you start break-evening too fast, you're going to run into that problem I've already explained. So now, let's talk about trailing. How would we trail our stops on this position? Well, we want to follow the same structure format. We have the high, the lower low, the lower high, the lower low, the lower high, and now the lower low. So at this point, the trade is already moving pretty close to the targets, and we have a clear structural format of lower lows and lower highs. So because we're moving very close to targets, we at least want to make some profits on this trade. So we could put our stop loss above the previous high, which is going to be this level just here. This means at worst case, we are going to pull around 2% profits out of the market, which is obviously not as good as the full 7% target, but it's a lot better than 0% or -1. Then, subsequently, every time the market goes and makes a new low, so for example, now that we've came down to this level, we could trail our stop in to the previous low just above that wick there. Now, obviously, in this instance, we kind of consolidated and then hit the target, so you wouldn't need to trail. But if we were extending this profit target out, for example, it would be wise to follow price action with our trailing stop loss. Now, something I also like to do is more aggressive stop loss trailing. So let's say we are going for a larger target, but we're getting pretty close to the target. Now, this is only for trades where we're getting close to take profits. If we're already 5, 6% into profit, I'm happy to take that. Anything above 3%, I'd be happy to take. So I go for a more aggressive stop trailing method. And that is by following each candle once a new candle forms. So we have here a bearish candle, as we can see. That is then followed with another bearish candle. When the next bearish candle forms, we can place our stop loss above the previous bearish candle. In this instance would be this candle here. Then when we get another bearish candle, we could move our stop to this candle here, the previous bearish candle. This way, we are following very tightly along with price. And many times the market will just run down and you'll just trail your stop behind every single low until you get all the way to or very close to your full target. But sometimes the market will flip on you like this. And when it does, it pays to just get out of the position and avoid turning what is now an already very profitable position into a loss. Now this is going to be a 5% profit trade at 1% risk. If you risk 2%, that's 10% done in a single position. And yes, you were reaching for more, but we are not trading in a perfect world here. We are trading in an unpredictable market where uncertainty is literally the only thing that's guaranteed. So using these trailing stops to safeguard positions is a really good way to make sure we take profit from a trade, even if it doesn't reach our full target. So make sure when you get into your trades, you're always prepared on how you plan to get out if things go bad. And make use of that stop loss trailing to minimize the losses you take and turn your trade into a win-win scenario. I talk more about this in my free course. There's a link at the top of the description for that. That's going to help you to build your first successful trading strategy. And if you don't want to do that, then just check out this video next. That's going to help you to progress on a similar topic as well. So thanks for watching. I'll see you in the next video.